Well, let me take this opportunity to welcome everybody to today's event, 2021 Second Half Market Outlook, July 7th. You got John Hopkins here, Tom Bowley can jump in just a minute to get this thing moving. Really do appreciate everybody taking the time to stop by today, especially those of you who are new to Earnings Beats. Come and see what we've got to offer. And of course, our seasoned veterans. Without you, we wouldn't exist. Really appreciate your ongoing support. This event will be recorded. If for some reason you're unable to stick around, no problem. We'll make sure everybody gets a recording as soon as practical. And this way you'll be able to listen at your leisure. It's hard to imagine that we've already plowed through the first half of the year, but here we are, right? Beginning of July, first half of the year is in the record books. And what a year it's been, right? Record highs in the markets. And Tom's going to tackle that, jump into that as soon as he gets started. I do want to mention that we've got some really good events coming up this month. Of course, today's event. Then we've got our options Max Payne webinar that'll be on the 13th of July. We've also got a couple of other things that are scheduled. We've got our model ETF portfolio where we share with our members those ETFs that we think can outperform the market over a 90-day period. That will happen on July 19th. And then we've got our Q2 earnings session, July 20th. That's always extremely well attended and popular event because by then earnings season will start kicking into high gear. Tom will start talking about some of the companies that already reported and some opportunities, as well as companies that have earnings coming up over the next 3 or 4 weeks. And really, that's when we shine, when earnings season kicks into high gear. Anyways, you'll see that when Tom presents our webinar special, you'll see those events listed on the calendar. Anyways, I know there's a lot to cover here, so I'm just going to jump right in and see if Tom's available to get this thing started. Hello, Tom.
Good afternoon.
Yeah, good. You're here.
I am. I think we jumped ahead of ourselves though on the date because it's July 6th as opposed to July 7th. But other than that, we are literally ready to go here.
Well, you can see that we've already, we're already forecasting dates. An inaccurate one, but nonetheless. Anyways, I'm going to go ahead and step aside because I know you have a lot to cover, and we'll take questions towards the end.
All right, sounds good. Yeah, we got a ton to go through today. First, want to welcome everybody into the session. I know you're taking time out of your day. This is being recorded, as John mentioned, and you can come back and review that at any point. It is hard to get through. There's so many things. I could talk probably for about 8 hours on just looking at the charts and seeing where we are and where we could be going and which areas, and looking at individual stocks and pulling those charts up, and then looking at the dollar. And I mean, there's just so many different ways we could go with this session. I'm going to try to compact it as much as I can, but you're not going to get through a second half market outlook in 15 minutes. It's just not going to happen. So I would count on at this point, probably at least an hour and a half for this session. I'm expecting it'll take until 6, possibly as much as 6:30. So it could be as long as a couple hours if for any reason you have to leave. Like I said, it is being recorded. Don't worry about it. You'll get to go back through and look at your leisure. But I do want to just make sure that I point that out because and most of our events, I'm sure this won't be the same, as they're time stamped based on the different areas that we're going to cover. And I'm going to walk you through that agenda here in just a second. But I just wanted to kind of let you know that that is a this is going to take a little while to get through the things that I want to cover today. Also, what I wanted to get into before we get into the agenda is, and I'll pull us up in just a minute so you can, and I'll walk you through it. But we always have these webinar specials anytime we have a webinar like this. So anybody that takes time out of their day, we try to give them a little bonus if they'd like to try us out at Earnings Beats. So if you do sign up for an annual membership, you'll get an extra month as a bonus month. So you get 13 months for the price of 12, and I'll go through that in just a minute. But first, let's go ahead and walk through the agenda for tonight, and I'll give you some of the things that we want to go over. I always start with the big picture. To me, everything else kind of fits inside of the big picture. So I'm going to walk you through a 100-year chart of the S&P 500. Usually I start these types of events with that big picture S&P 500 chart, just so you can see how insignificant sometimes things are. I mean, we went through this pandemic, and I'm not saying the pandemic was insignificant by any stretch, especially from a healthcare perspective. But when you look at it from a stock market perspective, it really is in the long term insignificant. What we just went through over the last year was very similar to what we went through in 1987. So you'll be able to see that on the chart when I go through it. Then I'm going to get into key ratios, relative strength, sentiment analysis, leadership, and then maybe throw out some potential trading ideas for the second half of the year. So I'm going to get into all that. Let me go ahead and share my screen with you. I do want to just point out this is the webinar special. So if you go over to earningsbeats.com at the top, you'll see this webinar special link. Click on that. You can come in here and check it out over the next few days. This will be until Friday the 9th. So you got 3 days to take a look. We have a no-cost trial. So if you're not a member of Earnings Beats right now and you want to try our service, you can do so for 30 days at no cost. But if at any point over the next 3 days you really like it, you think you might want to stick around for a year, you can go ahead and subscribe under this special, and you'll get not only the rest of your trial period. We're not going to cut your trial period off. You'll get the rest of your 30 days, and then you would get 13 months on top of that. And the total cost for the annual period plus the bonus plus your trial would be $997 over a 14-month period. And that compares to $1,900 if you did it on a monthly basis. So you can see that savings are pretty substantial. We just want to make sure everyone's aware of that before we kick things off here. All right, I'm going to jump in now. I'm going to start off with the big picture. And this is a chart I always like to show because when I talk about being bullish long-term, I come back to this chart. And it was almost a year and a half ago now, back in the middle of March of last year, in the midst of the pandemic, I wrote an article at Stock Charts, and I said we're in a secular bull market. And that was in the middle of this collapse that we were seeing. And I'm sure didn't maybe resonate with a lot of folks at that time because we were so caught up in the emotions of such a huge decline in such a short period of time. But I think over time, I've been proven correct that this is a secular bull market. Yes, it was scary last year, especially throughout March and into early April. But then things started to come back, and we've seen area after area after area. We've seen so much rotation in the market. And that's really been the hard thing as far as I'm concerned. It's not trying to decide whether or not the stock market's going to go up. It's trying to decide what area of the stock market's going to lead. And I think that has been incredibly difficult, really since about, I'm going to say late summer, maybe when the NASDAQ hit that high in early September of last year. I think that's when the market really got tricky in terms of just the rotation and what's going to lead next. Then, of course, we had the positive vaccine rollout, an announcement back in November of 2020. And, so much was going on. But when you look at this chart, the 100-year chart, and you just look really over the last several years, you kind of see, for the most part, just a market that just wants to keep going higher. And every time something gets thrown at it, it takes it in stride, maybe goes down for a period of time, but then comes right back to set new highs. That's what a secular bull market does. The 1980s, and 1990s, very similar. We had the 87 crash right in the middle of it. That was very similar. If you look at this, it's very similar to what we saw here with the pandemic, but it's all part of a big picture advance. And that's what I think is one of the most important takeaways as we go into the second half of the year, is that we are in a secular bull market. So always keep that in mind. Yes, we're going to have negative news. Yes, the media is we're going to have headlines. You know, earlier this year it was the inflation. Now almost nobody's talking about inflation, and interest rates are dropping again like there never was an inflation problem to begin with. All of this is just so normal for a secular bull market. But if you're not thinking secular bull market, it's very easy to become unnerved in this market very quickly. So keep this big picture chart in mind. Now, when you look back at these various bull markets, the secular bull market in the 50s and 60s, the average return during this period was 11.28%. The 80s and 90s were much stronger. The average annual return was 15.41%. Right now, we're sitting at just about in the middle of these two, 13.33%. And we've had this huge run up recently. I've actually done see if I can find this for you in a second here. I did an analysis because if you look back, these secular bull markets tend to last about 20 years. Once you break out above the prior highs, if you go back from the bottom, they last more than 20 years. In this case, from this low in 1942, it lasted about 28 years. If you go to this low in 1974, it lasted about, 26 years. I'm not talking about starting this secular bull market from this low back in 2009. I'm talking about the secular bull market starting when we take out the highs, which was 2013. That's when the 20 years begins. So this, in theory, if it is anything like the last two secular bull markets, we're going to be into the 2030s before this ends. Then we're going to have a pretty rough period for 10 or 12 years. I mean, if there's one thing that the stock market tends to do, is it tends to repeat itself over time. History definitely repeats itself in the stock market. Maybe not exactly. I mean, but if you look at some of these secular bear markets, this one back here, I mean, they're very similar looking. You know, you go down, you come back up, you think everything's over, and you take one more move, and the move is actually even worse than the one before. See that? Bottoms going in, taking out the prior lows before then reversing back to the upside. So it's almost like you got to convince everybody to sell, as many as you can possibly get to sell, and that's when the bottom's in. Anyhow, I think this goes on for another dozen years, perhaps. And here's the exciting part. If you think about the percentages, if we end up with an average of 15.41%, let's say it's 2033, so it's 12 years from now, and we've been going up, we've been enjoying this great bull market. And if we calculate and say, hey, the average return over the last 20 years was 15.41%, you know where the S&P 500 would be in 12 years? We would be sitting at about 27,000 on the S&P 500. We're at 4,300 right now. I know 27,000 seems outrageous, but if this bull market's like the 80s and 90s, that's where we're going to be. Now, if we want to take the more conservative 50s and 60s, because we only averaged 11%, in April of 2033, when we hit that 20-year mark, we'll be at 13,300 on the S&P 500. If we stay at the pace we're going right now, we'll be at almost 20,000 on the S&P 500. And then after that, the next 10 to 12 years tends to be painful. So we're forecasting, I'm not just talking about the second half of the year, I'm talking big picture here. But if we look at the next 12 years of the secular bull market and another 12 years of secular bear market, the next 24 years, I don't know how old everyone is. I know for me, 24 years is probably going to be quite a ways along for me in my lifetime, suggesting that these next 10 or 12 years could be the best years personally for me to invest for the balance of my life. And many of you may be in that similar situation. Maybe some of you are younger, but big picture, that's kind of a big deal because it wasn't easy to make money in the stock market when we were going sideways for 12 years. It's much easier when the stock market is putting in new highs. So think about this, and think about this when you're listening to a lot of the noise that you get in the media. Because the media, I'm not trying to paint a bad picture, trying to say that the media are bad people. They're trying to get clicks. And the way you get clicks is to write about the train wreck, not about the Boy Scouts. And so media just has a tendency to take everything and always look at the glass being half full, or excuse me, half empty. So there's always something wrong with the market, according to the media. And you never know when you have analysts coming out what their real agenda is. When Goldman Sachs or somebody from one of the big firms comes on to CNBC, you don't really know what their agenda is. They're trying to buy stocks for themselves. They're trying to buy stocks for institutional clients. Do you think they're going to be that nice to come on to CNBC and tell all of us first to get into this particular stock before they get in on their own and for their institutional clients? I don't think that's happening. So I don't really trust what their agenda is when they go on. I would much rather look at the charts. To me, that tells me all I need to know. I don't need to hear what they're saying. I need to hear what they're buying or see what they're buying. And so pay attention to the charts. Anyhow, we could spend an hour just on this chart, but bottom line is watch a couple of things. Number one, down here at the bottom, I've got the RSI. When you are in a secular bull market, if you look back at the last 3, including the one we're in right now, RSI 40 on a monthly chart tends to mark major bottoms. It just did it with the pandemic. Went down to 40. In the meantime, it's very normal for the monthly RSI to go above 70 and even into the 80s and even to approach 90, as we saw back in the late 1990s. So that's the range that you want to pay attention to. When we're in a secular bear market, the opposite is true. Look at the RSI, well down into the 20s, even into the teens. And that happens during secular bear markets. So one clue, big picture, even if you don't see the price action, is just simply follow monthly RSI or monthly PPO, because we have yet to have a secular bear market without the monthly PPO going negative. You cannot have a secular bear market without a negative monthly PPO, because the secular bear market lasts a long time, and it is long enough to enable the PPO to go negative. When you are in a secular bull market, you have these nasty corrections from time to time, or even cyclical bear markets, but they don't last long enough to drag the monthly PPO into negative territory. So those are some of the takeaways from this long 100-year chart. All right, now let's shorten it down a little bit. Let's talk about the S&P 500. This is a 15-year weekly chart. And I connected the major lows, which was the 2009, the bottom financial crisis, and then the pandemic, connect that. And when you connect that and then drag that same line, that same slope to the upside and connect the recent, or, connect the highest high, which was back in 2014, you'll see we came pretty close to connecting some of these other highs as well. Well, we are sitting right on that upper trend line. Now, I don't know that necessarily means we're going to go crashing, but I do think this summer, maybe what this is telling us is we could use a little pullback over the summer. Now, I think the next couple of weeks probably going to be pretty good for the market. But as we move into August and especially September, we'll want to look at other signals and see what everything else is telling us. But September tends to be, well, it doesn't tend to be, it is the worst month of the year historically. So as we get closer to September, we want to keep an eye on this. I mean, if we're kind of hugging this upper channel line, it could be that September kind of relieves us a little bit. Maybe we pull back right before the fourth quarter, and then I think we'll have another strong quarter into year end. My prediction at the beginning of the year, and you can see the S&P 500 beginning of the year was about 3,800. My prediction there was 4,700 on the S&P this year. We're at 4,340. I believe we'll hit 4,700 before the end of the year. It's always difficult to say where we're going to close, but I think we're going to get to 4,700. That's another 10%. I think we'll do it. May have to pull back over September, and then of course that fourth quarter can be very strong. But my feeling is we're going to eventually get to that 4,700 level. All right. When you invest in the markets, whether it's the stock market, bond market, whatever, there's always a choice to be made. Do you want to be more aggressive? Do you think the economy is going to strengthen? If so, you want to be in stocks. If you think that the market is maybe stock market's a little frothy, you think the economy maybe has run too far, it's overheating, maybe it's going to cool off, then you're probably going to want to pull your money out of the stock market and put it into the Treasury market. That's the relationship. Stocks and bonds, there's always, if you have $1 to invest, think of portfolio managers. They have $1 to invest. Every dollar they invest, they can put a certain percentage into stocks. They can put a certain percentage into bonds, but you can't just keep putting $1 into both of them at the same time. I guess you can leverage and do that for a period of time, but essentially it's the rotation from asset classes that really drives either the stock market or the bond market. The other thing to keep in mind is that the bond market, when prices move higher, yields move lower. Always. 100% inverse relationship at all times. No exceptions. When you see the yield going in one direction, it means bond prices are going in the other direction. When the yield's going up, folks are selling bonds. When the yield's going down, folks are buying bonds. That's always the case, 100% of the time. Now, what I have on this chart here at the top is the 10-year Treasury yield. Down the bottom is the S&P 500. And what I've done is I've broken down over the last decade these periods where the 10-year Treasury yield moves higher and when it moves lower. Now, keep in mind, when it's moving higher, bonds are being sold. Why would bonds be sold? Well, typically they're sold because you expect economic activity to move higher. And if that's the case, interest rates move higher. And if you hold on to bonds and you bought in at, say, 1.5%, and the economy strengthens and yields go to 2%, you're going to lose value in those bonds during that move to the upside because you're holding bonds that are yielding you 1.5%, and the new market rate of interest is 2%. So you're going to lose value. The thing is, when the yields go up, the S&P 500 tends to go up as well, because as the yields go up, money's coming out of bonds. Bond prices go down, stock prices go up. So look at this relationship. 10-year Treasury yield back in 2012 to 2014 going higher. The S&P 500 during this period gained 43.4%. During the next 2 years, a little over maybe 2.5 years, as the yield went down, the S&P 500 went up, but barely. And you might say, well, how can it go up? The yield's going down. That means money's going into bonds. So how can the stock market go up? New money. You've always got new money coming in the market. So as new money comes in, some of it's maybe a heavier amount of it's going into bonds, driving yields lower, but there's still new money coming into the stock market. So during a secular bull market, this is more the normal. Yields go up, stocks go up. Yields go down, stocks churn. Yields go up, stocks go up. Yields go down, stocks churn. Yields go up, stocks go up. This is not rocket science, but it's not really what you hear too much on CNBC. It's always, something that is meaningless really in the big picture. But these are the charts I think that make the most sense. So just, right now, yes, the yield's been coming down. And actually, this is probably the biggest surprise for me over the past couple of months. Not that the yields have come back down, because we went up so much. I wouldn't have been surprised to see a pullback. But I didn't think we were going to go back down below 140. That was the low over here in July 2016. Pretty close to the low that we saw over here in 2012. And so I thought we had moved up through that level. And I really thought 140 might be holding us to the downside. Today we closed at 137. Now, maybe that's just a little blip. Maybe we'll head back to the upside. But if the stock market's going to continue to move higher, in my opinion, one of the things that's going to drive it higher is the rotation out of treasuries, out of bond market. I think that's where the bubble has been. And so far, I'm being proven correct. A lot of money has come out of the bonds. We're seeing the yields rise. We've seen that over the last year or so. And I think it's going to continue. I don't know that we'll continue at this pace, but I wouldn't be surprised to see a little bit more pushback to the upside later in the year. That, I think, will be important in driving stock prices higher. If we continue to see this yield move down, I think the stock market will be choppy. And I think the rotation that we're already seeing from value to growth will accelerate, because low interest rates drive valuations, especially companies that can accelerate their earnings rapidly, because you're increasing the earnings growth rates as the economy improves. The earnings growth rates for these growth stocks go up, and you're discounting those future earnings back using a lower interest rate. That combination is powerful in sending valuations higher. So I think, if yields move down, I think that's going to really argue more and more toward growth versus value. If yields move up, I see the market going higher, and that rotation, we're just going to have to continue to monitor it. I think long-term growth outperforms value. That's just the way most bull markets operate. Now, I don't expect it. We had that huge run last year in growth stocks. I'm not expecting that. That was just, a crazy period, a 100-year pandemic. We're still feeling the effects. I mean, some of the prices that we saw in lumber going up and then coming back down, just everything across the board really has just been crazy in terms of the runs to the upside. And then all of a sudden they fall apart for a while. And, we saw growth stocks explode, and then growth stocks couldn't catch a bid. And now all of a sudden growth stocks are back in the limelight again. So it's this back and forth rotation, in my opinion, that's really creating the difficulty in terms of trying to outperform the overall stock market, the benchmark. And if you're struggling with that, what I would simply suggest is that you consider just being in the spider and and cut off trading for a period of time. But I do think there are going to still be a lot of trading opportunities. So I plan to continue to trade individual stocks. All right. So that's the 10-year Treasury yield. Now, we're also, one of the reasons we're seeing the stock market move up is this is what the stock market does as we head toward earnings. Two things drive the stock market: Fed policy, when they're accommodative, and, trying to light a fire under the economy, which is what they've been trying to do for years now. That's good for stocks. I mean, you can fight it. You can say they're wrong, but that's not going to help you get the stock market to come down. The stock market likes it when the Fed is accommodative. So Fed policy is number one. And number two, the fundamentals, earnings. Eventually, if a company keeps growing its earnings, I don't care what its stock price does in the short term. Long term, eventually, stock prices are going to go up if earnings keep going up. So those are the two key factors. And I wrote an article in Chart Watchers recently. This was back on May 21st. And if you haven't seen this article, I would suggest you go back and take a look at it, because to me, it's fascinating. I love to study numbers. I'm very analytical. And so I like to try to figure out the way the stock market operates. And I realize it doesn't always happen the same. But when it comes to earnings season, it's pretty darn consistent. Here were the periods that I studied heading into earnings season. For the most part, you can see that we end the period right about the same time. It's just as earnings season is getting underway. Now, when we start is pretty close to the same, except for December. And I think that's just Santa Claus rally, that holiday effect, which is very bullish in December. So that period got stretched out a little bit to account for that. But when you look at these four periods heading into earnings season, and you look at the annualized return of these periods, and this is going back since 1950 on the S&P 500. This isn't just the last 8 years while this secular bull market's been underway. This is through every secular bull market and every secular bear market since 1950. It's every year. It's every market environment. no exceptions. And you can see the number of days that are included in these calculations. Over 4,200 days, 4,267 days. 253 days, trading days is in a calendar year. So that is probably about 17 years worth of data. These 4 pre-earnings periods since 1950 account for about 17 years worth of trading data. And the annualized return is 24.5%. If I told you the next 17 years, we were going to average 24.5% a year, you'd probably want to be in the stock market, wouldn't you? That's what these pre-earnings periods are. I am always long going into earnings season. I don't care what what everybody's saying. Again, what's the agenda that's being promoted on CNBC or wherever? I don't know the agenda of the people coming on and saying earnings season's going to be a little rough this year. I'd like to have $1 every time I've heard somebody say that, the earnings growth for the S&P 500 is going to be 3% for the next 5 years. And I just look at these numbers that come out every quarter, and I'm like, who listens to this? It's not realistic. It's not worth listening to. So here you can look at history and just see the stock market does extremely well. Now, the percentage of up days, it's 52% in October, the days covered there, 57, 58% over the other 3 quarters, which is pretty strong because every day since 1950, there's about a 53% chance, 53.5% chance that it's going to be an up day versus a down day. So every day when you wake up and the market is open, there's roughly a 53.5% chance it's going to go up and about a 46.5% chance it's going to go down. And yet some people always want to be bearish. I don't understand. Market goes up more than it goes down. Always has, and probably always will. Obviously no guarantees, but I think stock market, if you believe that we're going to continue to grow, not just here in the US, but globally, prices are likely to continue going higher. Anyhow, when you look at these 4 periods, pre-earnings, you can see that 24.54% annualized return over these 4,000 days. All of the other 13,000 days that are not included in these 4 periods have an annualized return of 4%. And that covers roughly, I don't know, what is that, 50, 52, 53, 54 years? I don't know. Divide that 13,538 by 253. So 52 years. What if I said that the S&P was going to go up 4% each year for the next 52 years? You wouldn't be nearly as excited about the stock market. You might be looking at some other investments, maybe looking more dividend yields, sticking with those kinds of companies. That's the majority of the time. When you really need to be in the stock market, historically, is as we approach earnings season. Well, earnings starts next week, end of next week, or end of next week. So this is where we tend to go higher. And that's what we're seeing again, pre-earnings advance in the market. Let's keep moving on here. All right, next I wanted to talk about key ratios. So let's go back over here and let's pull up the next chart. So those of you that are earnings beats members, XLY, XLP, to me, that this is the most important intermarket relationship. I don't even know if you want to call it intermarket, it's really intersector or whatever. But this relationship right here to me is the most important. And if you think about it, it just makes sense. Our GDP is comprised roughly of about 2/3 consumer spending. So when we talk about the GDP, 2/3 of it is from consumers. And so doesn't it just make sense that we should want to know how the more aggressive areas of consumer stocks are doing versus the more defensive areas of consumer stocks. Because if that starts to shift more towards consumer staples, that's telling me of economic slowdown. Whereas if it's shifting toward consumer discretionary, the discretionary stocks, it's telling me, it starts to make me think economic expansion. So Wall Street, just by simply following this ratio, I think you can get a good sense of what Wall Street is expecting. And throughout secular bull markets, what you see on this ratio is very similar to what you see during an uptrending stock. You set new highs, you come down, you set higher lows, and then you go back up, you set higher highs, you come back down, you set higher lows, you go back up, you set higher highs. This is trending higher. If we were about to enter an economic slowdown, why would Wall Street be putting more money on a relative basis into consumer discretionary stocks? Makes no sense to me. And if you look at the S&P 500 and you look at the XLY, XLP, there's a little bit of variation, as to exactly when things go up or down. And of course, we had the pandemic last year, kind of threw everything, a monkey wrench into everything. But if you look longer term, what you're going to see, if you look at the correlation, which I have down here at the bottom, this is the XLY versus the XLP, and it's comparing that ratio, the direction in that ratio, to the direction of the S&P 500. And anytime we're up here in this blue shaded area, it means that the two are very positively correlated, meaning that if the ratio is going up, the S&P 500 is also going up. If the ratio is going down, S&P 500 is also going down. That's what positive correlation is. The two are going hand in hand. The higher you get towards one, the more positively correlated they are. Then when you get down to, say, this red shaded area, which is minus 0.5 down to minus 1, this is where you've got significant inverse correlation or negative correlation, meaning that the direction of this ratio and the direction of the S&P 500 are moving opposite one another. Well, one look at this chart for the last 10 years, and I think you can see there is nothing in this red shaded box. This consumer ratio and the S&P 500 don't veer long enough for us to ever make it below minus 0.50. That's over the last 10 years. Yet look at the blue shaded area. We're regularly up in this positive. So I think it should be pretty clear, just looking at this chart, that the direction of the XLY, XLP is really important to the direction of the S&P 500. I don't know that there's another ratio anywhere that's more important than this one. And by the way, I don't know if you noticed, Amazon broke out today. Amazon's 23% of the XLY. Look at the XLY just getting ready to make another breakout versus the XLP. This tells me that this market, this rally is sustainable. Now, does this mean that the S&P can't go down 5 or 10%? No. Don't misread this. I'm not saying that the stock market can't sell off. What I'm saying is that any sell-off is likely to be temporary. This uptrend is sustainable based on this XLY, XLP chart. I believe. Feel free to disagree, but I'm just pointing out the charts, and you can interpret them differently if you see differently. Next up, how about transportation versus utility? Think about this for a second. Again, going back to the fundamentals and just the common sense of it. Transportation stocks, when would they possibly go higher? Probably when more goods are being shipped, or when there's the anticipation of more goods being shipped. That's when your transports are going to do well. Utilities are more defensive. If the economy is strengthening or anticipated to strengthen, utilities are not going to do well. So this ratio, when this ratio is moving up, transports versus utilities, S&P 500 likely is doing very well. And if you look at the chart, I think it bears me out here. So if you start back in October of 2012, and you look at this nice rally, overall rally in transports versus utilities, you'll see during that period of 2 years, a little over 2 years, the S&P 500 rose 49%. When this was trending lower, the S&P was choppy. And then the yield or the ratio started turning up again. And over the next year and a half, S&P 500 up 43.8%. When transports are moving lower versus utilities, lots of choppiness. We ended up going down during this period. And then transports crushing the utilities again. And right now, over the last, really since the pandemic bottom, we're up 70.1% and counting. So I think it's really important. And if you go down here at the bottom of the chart, what I did is I compared the correlation of transports versus utilities to the S&P 500, and then also transports versus utilities versus the 10-year Treasury yield. And they're both similar. I didn't use the blue shading, but I think you can see that we spend a lot of time in positive territory on both of these charts, which makes sense because I've already pointed out that the S&P and the 10-year Treasury yield are positively correlated. So this ratio, transports versus utilities, should have a relationship versus the S&P and the 10-year Treasury yield that are similar. And that's what we have. Check this one out. Copper versus gold. Let's think about this one from a common sense perspective. What do you use copper in and what do you use gold in? I mean, gold is a hedge. It's just another currency. It's, you buy it as a hedge in case the market takes a turn. Gold usually goes up in value. I don't know too many commercial buildings that have a whole lot of gold in them. But copper, on the other hand, is an industrial metal. I mean, that is, copper is going to be used. If things are picking up, if the economy is strengthening, you're going to see an increase in demand for copper. At the same time, gold tends to do poorly when the economy is strengthening. S&P does well. There's not a whole lot of fear. Fear dwindles, and gold underperforms. You've got to also take a look at what's going on with the dollar. But usually under that scenario, when the economic activity is picking up, normally the dollar is strengthening here in the U.S. So, which also puts pressure on gold to the downside. So look at this chart of copper versus gold, and let's again look at what happens to the S&P 500. When copper is going up relative to gold, 2011 to 2013, during this period, the S&P went up 65%. When copper was going down versus gold, 2.5 years, we barely budged. A lot of sideways, ended higher, but not much. Then over the next year and a half, copper took off again versus gold. S&P in a year and a half was up 27.6%. Then we went through this 2.25 year period of moving lower, lots of choppiness. S&P went nowhere. Now we're strengthening again, copper versus gold. And during this period, S&P is up 56.5%. So very interesting correlations to be drawn based on this. But look at the correlation coefficient down here at the bottom. And once again, look at the red shaded area, which is inverse or negative correlation. It's almost a ghost town. I mean, if you're waiting for something down here, you're hearing crickets. There's not much going on. Here, blue shaded area, very positive correlation. So these are things to watch. Copper versus gold, transports versus utilities, discretionary stocks versus staples. These are the things that matter, not what you're hearing on CNBC. All right, one other relationship, and this one isn't to determine whether or not the S&P's move is sustainable. This is the IWF versus IWD, which I like to follow. You can see I don't even have it annotated, but this is simply growth versus value. The S&P 500 has been going up since the pandemic low, and it hasn't mattered whether growth was leading or whether value was leading and growth was underperforming. The S&P was going up anyway. So this is a ratio that this isn't one that I look to determine sustainability. I don't look at this and say, oh, growth stocks are underperforming. That means the S&P must come down. No, the S&P can go up. It's just being led by value stocks for a period of time. This ratio I use to try to figure out where in the heck the rotation is heading and to try to make sure that I'm overweighted in an area, growth or value, that is outperforming. And we did that in 2020. I mean, our portfolios were unbelievable. But then when growth took the hit in 2021, our portfolio suffered. Now we've got growth coming back again. And if you recall, when we did the portfolios back on May 19th, I'm like, well, I'm not quite sure. I think long-term growth is going to do well. Short-term, I'm not so sure. So we put a mixture together in our portfolios. And honestly, I just wanted to perform with the S&P 500. I just don't want to see any kind of a big, huge underperformance for another quarter. So that was the reason to kind of mix them up a little bit and do a little growth, a little value, and so forth, because this part is the confusing part in the market right now. And as we go into the second half, now that we're into the second half of the year, I still believe, I mean, if I knew right now that growth was going to lead in the second half, and I think it's going to, I like the fact that we moved back up above this 170 level. If you look at this, we got up to 170, failed, went above 170, came back down, tested 170, 1.7, bounced, and then went below 170, came up, tested it from underneath, went back down, and now we just went back through 1.7 again. So in the short term, it's telling me that the odds are that growth trade is back. And I'm starting to see it in some stocks. I really liked seeing Amazon break out today. Apple's been running. Still like to see Tesla maybe. Tesla's hanging above its moving averages, by the way, which I think is good. Like to see a little bit more strength there. But we're seeing other names that we saw before that were leading in 2020. They're starting to strengthen again. Zoom, DocuSign, CrowdStrike. These are the types of names that if growth leads in the second half, in my opinion, those are the kinds of names you want to make sure you have in your portfolio. But everybody's different. And these growth stocks, if they go out of favor, they can lose considerable amounts in a short period of time. So you have to offset what you're seeing on the charts with the amount of risk that you're willing to take. And everybody's different in that regard. I don't think there's a one size fits all. Some might be willing to take a lot of risk and go into a lot of growth stocks. Others might say, well, I normally don't go into growth, but maybe I'll do a little bit because it's starting to look more bullish. Everybody's different. And there'll be some who maybe are on fixed income who have no interest in a stock unless it pays a dividend, which you're going to see mostly are value stocks. So it varies and everybody's different. So you have to understand who you are in order to put all of this information I'm giving you to use, because everybody's going to take this information and maybe look at it a little bit differently. All right, let's move on to relative strength. So I want to talk a little bit now about sectors. If you look currently at the S&P 500, this is a weekly chart. I showed you that long-term 100-year monthly chart. Well, this is still long-term, but it's not that long-term. It's 15 years, and it's a weekly chart. And here's the connection of the lows from 2009 and 2020. And then I drug that line up to the top, connected the highs, and you can see we're right up, maybe even just above this upper channel line, which, that does bother me a little bit because we've made such a huge run. And that's why I'm thinking maybe later this summer, maybe even after earnings start, maybe we'll see the pullback when the earnings start coming in. And history tells us that that's the case as well, as I showed you in that article that I wrote. Pre-earnings, we get the moves up. Once you're past pre-earnings, you got to be a little bit more careful. We don't seem to have that same push to the upside. But as I look at this chart, and then I look at, this is another ratio. These are ratios that I would say are maybe more related to sustainability. I'd like to see the aggressive groups going higher. Now, that doesn't mean they can't pull back, but just Technology, especially consumer discretionary. I have consumer staples showing here, and I'll explain why in a minute. Then you've got communication services moving up. Industrials, with the exception of that pandemic, we've generally seen that moving up throughout this. Same goes with financials. Financials haven't been as good a performer on a relative basis, but they've been going along for the ride. Then they got hit by the pandemic, and now they're starting to try to come back up again. But when I look at these 5 charts, these 4 or 5 relative ratios of our aggressive sectors, I'm still seeing uptrends for the most part. And if you look at consumer staples, which I threw in here, look at consumer discretionary trying to turn higher here and continuing to put in higher highs and higher lows. And then look at the staple side of consumer stocks. We just moved to the lowest relative level that we have seen since all the way back in 2008. This is the defensive area. If Wall Street really believed that we were topping, wouldn't you think that more of the money would be rotating into defensive staple stocks? I mean, this isn't telling us how much money is going into, say, the bond market versus the stock market. This is only looking at money in the stock market. And where is it going? Staples on a relative basis versus the S&P is going down. Consumer discretionary on a relative basis is going up. That doesn't look like a bear market, or that we're anticipating a bear market. This is bull market behavior. So again, these are signs that tell me we're not done. I can't say the market's not going to have a 5 or 10% correction at some point. I mean, that happens out of the blue sometimes. I wish I could call every one of them. Sometimes I see signals, other times I don't. But I'm more interested in that big picture, because if I can get that right, I'm going to do all right in the end. And I'm still seeing bullish signs. Let me show you the difference between a market that looks like it's sustainable, which I think this is a market rally, and a market rally that's destined for failure, which we saw in 2007. Let's look at this same chart for 2007. So here we are right here, this vertical red dotted line. This is close to when we topped. This is October, late October 2007. Now, if you look at technology, we were okay. Technology did okay and held its own during the bear market. Now you might say, well, technology didn't go down. Sure, it went down. This is a relative chart. So what it's saying is that it's basically just doing what the S&P 500 is doing. Well, the S&P 500 was going down. So technology was going down by about the same amount. Every bear market is different. If you look back to the bear market in 2007, 2008, it was all about the financials. If you look back to 2000, 2003, it was the dot-com bubble bursting. A lot of it was about technology. So not every bear market's going to be the same. In this case, technology held up okay, but look at discretionary stocks. Before, at the top, right here in October of 2007, look at where the discretionary stocks were versus the S&P 500. Discretionary stocks were at a multi-year low on a relative basis. That's telling me money is rotating out of discretionary. Why would you do that with a stock market at an all-time high? Unless you believe the market's not going to keep going higher. That's the significance of seeing consumer discretionary stocks performing poorly. On the flip side, let's look at that consumer staple group, which by the end of 2007, still pretty close to the all-time high. By the end of 2007, the XLP was at a multi-year high versus the S&P 500. Do you see the difference between where we are now versus where we are or where we were in 2007? I'm not seeing the signs. And that's why when I start seeing media headlines, oh, inflation's a big problem, or the trade war, or, oh, it's the pandemic, Yeah, the pandemic was a big problem, but it was a big healthcare problem. It wasn't a big stock market problem. All of that was way overdone. And I think subsequently we see now that it was way overdone. Should have never seen a sell-off like that. Why did we see it? Well, everybody's got their theories, but I think the media. I mean, it was so overhyped. I mean, we all thought we were going to die for about 30 days. Who wants to be in the stock market? My gosh, we're going to close down economies. Great Depression 2.0. I can't tell you how many times I've read about that. And yet, as earnings beats members know, throughout 2020, I kept talking about accumulation distribution. Many of those technology names, many of those growth names were showing new highs in accumulation distribution while their prices were going lower. So everyone was panicking out of these high growth areas, and Wall Street was buying them. Of course, you weren't hearing that in the media. You were hearing Great Depression 2.0. So you got to follow the charts. You've got to follow the charts. I honestly, I cannot tell you the last time I had CNBC on. I haven't watched it in years. I go to their website sometimes to get information on crude oil or something like that, but I do not follow the news. I will not. I try not to be skewed by news because it's opinion. It's just clickbait. It's trying to get people to come to read their article or their, outrageous headlines. And I just don't do it. Follow these charts. Look at financials, by the way. This was the all-time high. It's generally not a good sign to see financials breaking down to a multi-year relative low when the stock market's at an all-time high. Just not. So that was one sign. Of course, discretionary. I think consumer stocks are probably the most important stocks to watch. Staples versus discretionary, or discretionary versus staples. Always keep an eye on these. All right, let's move on to sentiment issues, sentiment analysis. So let's talk first about the VIX. Now, one thing I like to do in the short term, to call short-term tops, is to study the 5-day simple moving average of the VIX and to compare it to what the S&P 500 is doing. Normally, the VIX gets fearful and the VIX spikes higher when the S&P drops. That should make good common sense. Stocks go down, people start to panic. When it goes down a lot, they panic more. And the VIX is a measurement of that panic. So the panic level goes up when the stock market goes down. It's an inverse relationship. Well, in the short term, you can run into difficulties, and I'm not going to go through this chart. I've done it before, and it's been in some recent articles, and we've got limited time. But in the short term, when you see the VIX moving up and the S&P 500 is moving up, be careful. Put a correlation coefficient on your chart with the VIX and the S&P 500. And when you see that correlation, which is almost always negative, most of the time close to a -1, if you see that go positive, and especially go positive up to about the 0.5 level, look at everything else on your charts, because that could be a major warning sign. I wrote about it. I mean, if we go into the blogs, let me show you. I can get to it very quickly. If you go to Trading Places, my blog there, whoops. Hopefully we're not having problems over at Stock Charts. All right. Anyway, if you go to Trading Places, you can go back to September 3rd. You can go into the archives of my Trading Places blog and then go back to 2020, September 3rd, and read that article, and you'll see exactly what I'm talking about with the VIX. Now, on this particular chart, this is a longer term chart. What I'm mostly interested in is when the VIX rises to certain levels. It's hard to call tops using sentiment indicators. I just don't think they're as reliable. I've studied it for years. Sometimes it works, sometimes it doesn't. And so I feel like it's almost a coin toss. So when I see the VIX get down, I mean, when the VIX goes down to the downside here around 10, it's telling us that things are pretty complacent. But you can see we stay here sometimes for months and months. before we see any kind of selling in the S&P 500. So a lot of times I'll see folks say, well, the VIX is down to a certain level, and that means the market's topping. And I just look at the long term, and I'm like, I don't draw that conclusion. Yeah, a lot of tops do form when we're down there, but we're down there a lot without tops forming. I think the more reliable indication using the VIX is marking bottoms, where the panic starts to come in. When you're in a secular bull market, and here's where I drew the line. This is where in April 2013, the S&P 500 finally cleared the 2000 and 2007 highs. That's when the new secular bull market phase began. When you get into secular bull markets, I think any trip above 30 on the VIX is either marking or about to mark a major low. I'm going to say intermediate term low, not long-term low. The long-term lows tend to be marked by these crazy, irrational, throw the baby out with the bathwater lows in the stock market. So the 2009 financial crisis, the 2020 pandemic, the 1987 market crash, the 1974, oil embargo period where we had all the problems back then, the 1940s, those are long-term lows that we will never see again. I don't think we will ever see the 2009 low again. And I'll be honest, I don't think we're ever going to see the 2020 low again, ever. Because there was so much negativity that drove the price down to an unreasonable level. I think we're going to, if I'm right about the next 10, 12 years, some of those numbers I told you, 12,000 on the S&P 500, maybe even as high as close to 20,000, 25,000 on the S&P 500. Are we going to go back to 2,300? I don't think we are. So what I would pay attention to, look at these secular bull markets spikes in the VIX. You see how when we got to 30, now here we got up to just over 50 intraday. Didn't last very long. Same with the one in 2018, early 2018. For the most part, if you get to 30, 35, that area to me, I would be looking for a bottom. I would be looking on the 60-minute charts to maybe see a positive divergence, something to corroborate. And then I would start getting more aggressive in the market on the long side as a trader. If you're a long-term investor, you're just holding through all this. You don't care. It's secular bull market. You're riding the ups, you're riding the downs. So what I'm talking about here is much more important for a trader. Somebody who swing trades, somebody who day trades, somebody who position trades, whatever. These spikes in the VIX are really important. Now, recently, you see over the last year and a half, we've had some spikes up into the 40s. I just think they're aftershocks. We went through this like an earthquake, similar to 2009, 2008. And you can see these aftershocks getting up into the 40s to around 50. That is a little bit more prevalent after you've seen the VIX going up to 80 or 90. I don't believe we're going to see that going forward. I think 30, 35 is probably where we're going to see that VIX top out when we do have a 5 or 10% correction. Maybe even a 20% cyclical bear market. But, we've had 2 of those in the last 3 years. I don't think we're going to have another one for a little while at least, but you never know for sure. But I'd be looking, I think we will have 5, 10% corrections from time to time. And when we get that VIX up 30, 35, that's probably going to mark the bottom. All right, let's keep moving on. How about the equity only put call ratio? Very similar to the VIX in that, when you get a reading down on the bottom here, when we get really low, this is a 5-day moving average of the equity only put call ratio. As we get down toward the bottom here, it's telling us that there are more calls being traded than puts. I mean, the numbers really skewing more and more historically toward calls, which you would think means it should market tops. Doesn't always do that. If you look at this and you compare these bottoms to the top, some of them you can look at and nails it right here. Looks like April 2010 nailed it. But the summer of 2009 had the same reading and we kept going higher. And so this is where I have problems. I mean, here we were low and we kept going higher. Here we were much closer to marking a top. So it's almost a coin flip, like the VIX. These sentiment indicators, in my view, don't do as good a job at marking tops as they do marking bottoms. Now, when everything skews toward puts and the market's extremely fearful and the baby's going out with the bathwater and everybody decides that you can't lose money buying puts, that's when bottoms go in. And so you do want to watch this ratio when it gets up to 0.8 or above on a 5-day basis. I mean, this is when you can see significant. I mean, this is almost perfect, too good to be true kind of analysis. Now, when you get to 0.8, the problem is, are you going to go to 0.85? You're going to go to 0.87? You're going to go to 0.90? We don't know. So when it hits 0.80, you may not be getting right at the bottom. But what it is telling you is that you're getting very close. Everybody is starting to bet on the put side, and that is not a smart move to be shorting or buying puts when you see the put call ratio get to this level. So keep that in mind. All right, moving on now, I want to talk a little bit about leadership. You know, when we talk about leadership, one thing that we really do need to at least discuss temporarily is the dollar. Because I can talk about aggressive areas of the market like technology, consumer discretionary, and defensive areas like utilities, real estate, consumer staples, so forth. But energy and materials kind of have a mind of their own. I don't categorize them as aggressive or, I mean, I've seen energy and materials lead during not so impressive bull markets. I've seen them lead during bear markets. I've seen them lag during both. There's no rhyme or reason. It's partly, I'm not even going to say partly, it's probably primarily due to the direction of the dollar. Is the dollar strengthening or is the dollar weakening? And the way I try to determine this, and I've had a few folks write into me and give me some really good information about, you know, maybe tweaking this a little bit. I don't know. For me, I'm more comfortable, I think, just with what I have developed here. I just haven't been able to get more comfortable using something else. And I think this is fairly easy to explain. Essentially, this top part of this chart is the 10-year Treasury yield in the US minus the 10-year Treasury yield in Germany. And when I look at countries, I see the most positive correlation between US and Germany. And that's why I'm using the 10-year Treasury yield in the US versus Germany. I just see it in the stock market. I see it in the bond market. It's just very positively correlated. Whereas when I look versus China, you'd think China, you know, big market, huge population, that's the market we should compare. The correlation's all over the place. There is no set positive correlation. It goes positive for a while, and then it goes negative, inverse for a while. I just can't trust it. With Germany, it seems to be much more consistent. That's why I'm using Germany. Just wanted to explain that. So as you can see, this is just telling us when it's rising, it means our yields are going up faster on an absolute basis than Germany. Okay. So if our 10-year Treasury yield jumps 10 basis points and Germany's jumps 5 basis points, then this difference is going to jump 5 basis points, the difference between our 10 basis point jump and Germany's 5. And then if Germany's rising faster than us or going down slower than us, we will see this difference in yields coming down. Well, if you look at this and compare it to the US dollar index, I mean, I kind of think it looks similar. And if I go back to my economics 101 roots back in the 1980s, when I first started learning about economics, you know, there wasn't so much a global market back then. It was more really domestic. You know, what happened in the US was really most important in determining the direction of the dollar. And I just remember if the economy was strengthening, the dollar would go up, rates would go up, yields would go up, and the dollar would go up. And then, of course, when the economy was contracting or expected contracted, the opposite would happen. We'd see the yields in the U.S. going down. Well, when we became more of a global market environment, I think some of this has changed. And it's now, I think you really have to look at what the U.S. yields are doing. I think what we're doing in terms of yields follows what's going on in the U.S. in terms of economic activity, but also what's going on in Germany from an economic standpoint directs their yields. So by comparing our two yields, we can get a better sense of, is our economy strengthening more than Germany's? And if it is, then the dollar should be going up. And if it's not, then the dollar probably is going to be going down. And so this correlation that I have on here at the bottom shows the difference between, it's looking to see if the difference between the two yields in our two countries correlates positively or negatively with the dollar. And as you can see down here, we're mostly in positive territory. So I think my theory has been proven, but it's not perfect. And you can see these circled items down here is when we have some rather negative correlation. And when we've done that, there have been some interesting developments. So here what I did is the green shaded areas mark periods where the 10-year Treasury yield in the US is going up faster than Germany or going down slower than Germany. It's just the difference between the two countries' yields. When we're seeing this difference going higher and the dollar going down, that is marked in green shaded area. When we see the opposite, yields in the US moving down versus Germany and the dollar rising, we have a red shaded area. In every case so far, the inverse correlation, as we start to move back toward positive correlation, it's the dollar that plays catch up. So the dollar was going down, the dollar rallies to catch up. Here, yields going up, dollar going down, dollar rallies to play catch up. Here, yields going up, dollar going down, dollar rallies to play catch up. Here, yields going down, dollar going up, dollar sells off again to play catch up. And now here we had the dollar or the yields going up, dollar going down. And so I'm expecting the dollar to rise. Now, if you look over the last couple of months, we've been seeing this yield moving lower again. Now, I think it's going to turn back to the upside, but at least for now, in the short term, it's coming down. So that's adding a little bit of uncertainty for me, but the overall period is still higher. So I think this is going to break to the upside. I would say this, watch the dollar index at about 88, 88 and a half. And that's why I put this real thick line in here. See the double top in the dollar index over here at about 88, 88 and a half. And then over here at the bottom, we came down to about 88 and a half. So can we hold on? If we do, I think the next move in the dollar is to the upside. And I mention all of this because if you look at the dollar, here's the direction of the dollar back in 2002 to 2008. You see the dollar falling? What's energy and materials doing on a relative basis? They're beating the S&P. Then we went through this 2 or 3 year period where it couldn't make up, dollar couldn't decide where it wanted to go. Energy and materials couldn't decide what it wanted to do. And then we bottomed in the dollar and the dollar went up for several years. And what happened to energy and materials? They went down on a relative basis. Well, right here, I'm kind of circling this because we broke below this uptrend, but we didn't break below key price support on the dollar. And notice materials. And I've been cautious as we've been going up in energy and materials on a relative basis. I've kept saying, be careful. And if you look at materials closely, since topping back in 2011, we have been putting in lower lows and lower highs, lower relative low, lower relative high, lower relative low. So this is the relative high we want to watch. We got up almost to it and then went back down again. Now, at some point, if the dollar breaks down, then I believe materials will break out. And I also believe that we will want to be careful with inflation because as the dollar goes down, commodity prices tend to go up. And that could trigger a potential inflation problem. But I don't think that's going to happen. I think the dollar is going to hold support. The dollar is going to go up. And I think energy and materials are going to roll back over again on a relative basis. That doesn't mean that energy and materials stocks are going to collapse. Doesn't mean I think crude oil prices are going to go back to $20 a barrel. I think we're probably, I do think, and I mentioned recently, I thought crude oil, if we got $77 a barrel, that West Texas intermediate, we got to, I think this morning, 76.95. Remember that ascending triangle? Those of you that are Earnings Beats members pointed that out when we broke through $67 a barrel on oil, said that measurement was 77. We got to 76.95 and then turned around today. So I don't know if that's the end, but that's going to be a level to watch very closely, because XLE, unless we break out on oil above 77, I think the XLE probably will underperform. Same goes for materials, XLB. So anyway, I think that's really important as we look into the second half of the year, because energy and materials did pretty well in the first half. You can see energy up there in the first half of the year. I think it was the number one performing sector. If I'm right about the dollar going higher, I think energy could be the worst performing sector in the second half, or down there with materials. So something to keep in mind. Obviously, we're going to continue to monitor it throughout the second half, but this is something I would be keeping in mind. All right, let's take a look a little bit more at this leadership. So we started with materials and energy, but I wanted to move on using RRG charts to take a look at some of these key areas, different sectors, particularly the aggressive areas. But and when you look at RRG, it's going to vary depending on whether or not you're looking at the weekly information or the daily. Weekly takes, just kind of think about trying to push a 5-pound object versus trying to push a 5,000-pound object. Weekly charts take a little while to really start to react to what's going on in the near term. The daily charts, the daily RRGs, are much quicker to react. For instance, when you look at the weekly chart, right now, energy on the RRG chart still remains the best performer. And real estate and financials are 2 and 3 in terms of relative strength. These are the ones that are furthest to the right. And this down here at the bottom, this is the relative strength axis. So it's kind of looking at it right here with this vertical line. If you're on the right side, you've got good relative strength. If you're on the left side, you got poor relative strength from a long-term perspective. And then over here on this side, you'll see this is momentum. So the horizontal line is kind of determining anything above got good momentum. Anything below has negative momentum. So anyhow, I just wanted to kind of point that out for those of you maybe who are not used to looking at our RG charts. But you can see real estate, financials, and energy on the right-hand side showing relative strength. Let me switch this to daily and take a look at the difference. Now what's over here? Technology, consumer discretionary, healthcare, and communication services. Where's energy? Energy's been struggling here on the daily chart. See how it's just moved into lagging? Real estate's just moved into lagging. That's why on a weekly chart, we haven't really seen anything yet, because it takes a while. So, it's really just like looking at a stock chart. If you look on a daily chart, it's making a short-term breakout, but then you look on its weekly chart and it's still got overhead resistance. You got to be careful. Short-term, it looks good, but long-term, you've got resistance. And so I would kind of balance the two, the daily and the weekly charts, and always, and I mean always, look at a price chart before you decide to buy or sell. And even Julius DeCampinar, who is the founder and creator of these RRG charts, he's a good friend. We've had him over at Earnings Beats many times. I've had him on my shows over at Stock Charts TV. He has said over and over and over again, he does not buy based on these charts. He gets ideas from these charts and he gets visual pictures from these charts, but he always buys looking back at the price charts. So always keep that in mind. I wouldn't just look at this and say, XLY is leading, I'm going to just go buy it. I think many times it'll turn out to be a mistake. You still want to buy based on price action. But as you see what's going on here, I mean, let me max this out here. If you follow technology right here, and one thing you can do is you go down and if you click on the one you want to follow, technology, highlight it, you can see it highlights it on the chart and the others go a little bit in the background. So now I can really follow what's going on with technology. And so technology's been leading. It's the furthest over to the right. Short term, it's starting to show maybe just a little bit of a turn back down here. But a lot of times on the daily chart or even on the weekly chart, you can see this rotation, leading, weakening. It doesn't always go to lagging and then improving. Sometimes it'll be leading, weakening, and then it turns right back up into leading again. That's what leading sectors, leading stocks, leading industry groups, that's what they tend to do. So keep that in mind. Now, with all the rotation we've seen in 2021, we have seen a lot of this back and forth, which again is making it really difficult to trade. You know, value will be leading. You get your portfolio set up with value stocks, and all of a sudden, a couple of days later, you've got growth stocks leading again. Then you're like, okay, do I take my loss in value, move back over into growth, or is it going to reverse again? And so those questions repeatedly go back and forth in your mind. And I've never really seen the rotation be so severe between growth and value as it's been over the course of the last 18 months. And that's what's making it difficult. It's not, and I said this back in November of last year, I felt the market was going higher, but the key and the hard part was going to be rotation, trying to figure out what is leading and what's going to lead. A lot of it will be dictated by interest rates. There's no doubt about it. If rates stay low, I think money is going to rotate big time back into growth, probably the whole second half of the year, with pullbacks along the way, of course. But if interest rates all of a sudden shoot back to the upside, then I think you're going to see value get more than its fair share. So it's just, you know, I definitely would be keeping an eye on the bond market. All right. So when I look at this, you know, I see the aggressive groups, XLK, XLY, XLC, and even healthcare, which is, it's defensive, but there are definitely components of healthcare that are more aggressive, especially biotechs, maybe even medical equipment. Not so much pharmas. Pharmas are more defensive. But XLV is kind of there. It's just a mix of aggressive and more defensive areas. Anyhow, so I want to concentrate on technology because I do believe technology is an area that you know, we'll want to focus on in the second half of the year, just because I do think growth will do well in technology. If you go back to the beginning of the secular bull market back in April of 2013, technology is your best performing sector by far. Then you've got consumer discretionary and communication services. So I think consumer discretionary versus consumer staples is the most important to watch. But when it looks like a rally is sustainable, like it looks right now, I think technology is your best area. And I think consumer discretionary is probably your second best area, along with communication services. So anyway, I pulled up technology here. What this does, if you go into these groups right here, this drop-down menu, and you go over here to this XLK members and just click on that, it'll bring up all of the stocks in that XLK on an RRG for you. Now, what I would do is kind of focus on some of these, maybe something like, you know, coming from weakening back in toward leading. So I think a stock like Zebra right here, I'll highlight it so that you can get a better sense of what it's doing. But see how far out to the right it was? It was one of the stocks showing the most relative strength within technology. This was back in March. And then, of course, we had all of those growth stocks getting hit, and Zebra took a hit just as well. But now, as we start moving into June and July, look at it starting to turn back up again. So this is one of those leaders that's beginning to show strength again. So these are the types of stocks that I would be interested in. Now, I want to go ahead and maybe pull up the XLY. We'll update here. Oops, I didn't want to do that. And let's see here, one of these stocks that's looking pretty good. Maybe Darden, or was it DRI? Yeah, Darden Restaurants. I think that one, yeah, see that one's curling back up. So let's drag this. And so you can see again, had tremendous strength. This was as of April 12th. So this one did pretty well, even after some of the move away from growth. But you can see the big decline there. And then is June, we got the June 7th, June 14th, June 21st. Now it's all of a sudden it's starting to try to turn back up. So again, what I would be doing is looking at this and then maybe going over to say, let's pull up a different chart. Then I'll pull up a chart on DRI and just see what it looks like. Well, the relative weakness, it was consolidating. It just broke out. Look at the volume today. It was down to 145, came back up, finished near 149. I think this stock looks pretty interesting to me. So yeah, I mean, a 20-day test would be interesting, or just simply the fact that it's broken out after sideways consolidation. Let's look at another one here. See if there's another stock in here somewhere. eBay looks like it's really strengthening again. So let's follow eBay and see what was going on here. So eBay got very strong, went down, strong, and it's just been kind of hovering here. Now it's starting to strengthen again. So let's see what that looks like on a chart. Well, made another breakout. So it broke out, pulled back to the 20-day, got back up through new, set new highs, and now today pulling back again, 67.5 or so. Probably a pretty good area of support along with that rising 20-day at 67.03. Let's see what else we've got. Wanted to see if I could find, here's Amazon. So Amazon just broke out today. Let's see what's going on. Look at it, it's just moving into the leading area. Now, these are actually the types of stocks I know I've heard Julius say he likes. You know, we're going to want to see if this starts to pick up in terms of, and this is weekly, by the way. So if we, I'm going to stick with Amazon, but let's go daily. I want to see what it's doing on a daily basis. By the way, there's CMG. Look at Nike taking off after its earnings last week. There's eBay, by the way. Or is that, no, that's Etsy. But let's look at Etsy first. I want to come back to Amazon. All right, so here's Etsy. Now, first of all, last year, Etsy was way over to the right. Look at this move. It's actually even off the chart. It's so far to the right. And it's still way to the right, but now it's moving into the weakening. And then this was probably, yeah, this was back in the fall of last year when many of these growth stocks just struggled and never really came back. Look at Etsy on a relative basis. And then it shoots higher again, comes back down. I mean, it's all over the place, really. But I'm going to fast forward to where we are now, because there's Etsy. And now here it comes improving and moving into the strengthening. Look at that thing really strengthen. So as it moves into here, Etsy probably would have been one to take a look at. So let's see what that's done over the last week or so. Yeah, definitely making the breakout, getting back above key moving averages. Last 2 or 3 days, those pulled back. You know, if I was going to take a shot on Etsy, it would be as it tests the 20-day moving average. All right, let's take a look at Amazon. So Amazon right now has moved back down into the weakening. It's still on the right side of this vertical line. So it's still telling us we have relative strength, but we are closer and closer. I'm just kind of watching here to see. So here was Amazon. So you can see recently that things really picked up with Amazon, and that would have been as we were getting close. I'll finish this in just a second. Let's take a look at Amazon and see what's going on here. So Amazon, see this pullback? That's where we're going to see things move back into that weakening area. So here, let's see. So this was as of June 21st. So these last couple of weeks, we pulled back and let's see. Hold on one second. Okay. So Amazon, you can see now this is coinciding with this pullback right here, the end of June. So if you look over here, it'll give you the date. This is July 6th. So if we go to the end of June, right in here, this is what's happening as the price chart is pulling back to this 20-day. But then we absolutely exploded through today. And this is after months, almost a year of consolidation. That's a big, major breakout on Amazon today. But on the RRG, look at what it's doing. With today's action, it was going lower and there was an abrupt turn. And I have a feeling we are going to see Amazon turn right back up into that leading quadrant here over the near term. But we could, get rid of that, and then we could look at all kinds of different stocks on here. But this is just one way. At Earnings Beats, and all of our members know, we have a lot of chart lists that we use to try to identify great trading candidates. RRG is just a different way, especially if you're not an Earnings Beats member. What I would be doing to try to look for some stocks that, pretty easy. This is an easy way to try to find stocks that are outperforming and could represent some really nice trades in the near term. All right. Let's see what else we had. I don't really have a whole lot more. I was going to show you a couple of stocks I mentioned earlier. I think that these stocks are beginning to show some nice relative strength. They're trending higher above key moving averages again. And so I own a few of these. And so I thought I would just share them with you. First was Amazon. We already went over Amazon, but I loved Amazon on this breakout. And I also really like the XLY because of Amazon breaking out. Amazon's 23% of the XLY. So that should bode well for that sector ETF. Another one I want to point out, I like Tesla, and Tesla's been a little slow, but I want to point out two things today. Today's low went to 651. The 20-day EMA is at 649.98 or 650. $1. We were just at 700 on Friday, and now today it hit 651, which is $1 above its 20-day. Now maybe Tesla's going to roll back over, and maybe it's going to go back below the moving averages. And if it does, I'll be stopped out because this is a stock that I'm looking to hold off of gap support, the moving averages. And it's not just this 20-day EMA. I want to show you the 20-week EMA. So we went back through the 20-week EMA over the last 2 or 3 weeks, and notice the 20-week EMA is at 651.08. Today's low was 651.40. Can't get much closer to a 20-week test. So it's the 20-week and the 20-day. So anybody looking at a weekly chart is going to see this moving average. Anybody looking at a daily chart is going to see this moving average. And Tesla bounced about $8 off of that into the close today. So Tesla's one that hasn't already made a huge move. I mean, obviously it did a year ago, but I'm talking about off the high from 900, pulled back to, 570 or so, but it's been this, going through this consolidation. I think this is one that could really make a run heading toward its earnings in a few weeks. Another one that I really like, and I've been talking about this, Zoom. I just think this is a great company. We use Zoom. That's what we're using here for this webinar today. I think this is a company that's here for the long term. I don't think this is just a one-year wonder from the pandemic. I think that business is a lot easier now because of Zoom, and Zoom's got competition. It's got Microsoft Teams, which has an unfair competitive advantage when you think about it. But I still think Zoom, even as an independent, is going to have a bright future ahead. I really like the chart. I like the fact it's back above its 20-day moving average. It's trending higher. The PPO has gone positive. And if we pull up the weekly chart on Zoom, you can see that we've climbed back above the 20 and above the 50 week. And look at the the weekly PPO now turning positive again. So after a few months of being negative during that horrible period with growth stocks, we're actually seeing that turn back around. So I wouldn't be surprised to see a run here on Zoom up to 450 to challenge where we were right around that earnings report recently. Another one I would point out that I think looks really good is DocuSign. Of course, it's made a huge move, but it's consolidated for a long time. Sometimes you look at it and say, well, I don't want to buy it at 290. I could have had it at 190 a month ago. Well, yeah, but you didn't. We didn't go after it then. It also could have been a stock that you bought at 290 a year ago, almost September. And now here we are a year later and you're still at 290. So it's all based on perspective. I don't worry about where a stock was, last month or last year. I worry much more where I think it's going. And I like DocuSign. I see the volume picking back up again. This was another breakout. This was an all-time closing high today on DocuSign, I believe. Let me go back another year just to make sure. Yes. So that September high, today was an all-time closing daily high on DocuSign, and the volume picked up on that. So yeah, the market was a little rough today throughout parts of the session, but we did see many of these growth stocks benefiting again. And that's a positive sign in the short term for some of these stocks as we head toward earnings season. After earnings come out, we'll see what's happening. We'll look at the other signals and so forth. But that's basically what I wanted to go over. So I don't know, John, if I've got time. If we have some questions, I'd be happy to answer them.
Well, that was very thorough. Well done. Thank you. Yes, David has a question. What is better in analyzing price chart? On a total return basis or unadjusted? The latter shows price appreciation or depreciation versus adjustments by dividends and or splits.
Well, I mean, anytime you're evaluating return on investment, it's the total return. I mean, it's whatever your capital appreciation is plus any income that's derived. So total income is always the better answer. For me, being a trader, I don't concern myself really with dividends. If I happen to be in a stock when it pays a dividend, to me, it's just a little bonus. Thank you very much. But I'm not looking to get into a stock just because of a dividend, upcoming dividend or anything like that. It's really about the chart and, can I make money based on the chart? So I don't know if that answers the question, but I think it really just comes down to what your objective is. I think for those who are more income oriented, I think total income is much more appropriate.
Okay. Question, somebody asking on your comments on DocuSign, in the near term, do you see a negative divergence forming?
Well, let me go back here and take a look at DocuSign. Well, it's very, very early. I mean, you can get yourself in a lot of trouble when a stock first breaks out, because you almost always have a negative divergence when a stock first breaks out. And I would take you back here to May. Let me show you what this, I'll show you exactly. So let's say May 6th of 2020, we broke out. And even just before that, maybe.
Are you trying to show something on the screen? Because it's not showing.
Oh. Okay, well, thank you for that. Before I finish showing it. All right, you should see it now.
Yes.
Okay. So I'm going to go back to May 5th, 2020 on DocuSign. So you can go back here under range, select start date. Let's go 2019, and then we'll go to May 5th, 2020. See how we're breaking out here? See how that PPO is lower? Very similar, kind of what we're looking at right now. But if I go back and look at that chart, if you had gotten out right then, May 5th, look at what you'd have missed to the upside. I mean, divergences, number one, they're secondary to price action. I never use divergences as my go-to to buy or sell a stock. It's always about the price action, number one. And that's just one of, divergences are just one of those corroborating indicators. They either, would I be watching it because of a negative divergence? Sure. But if you follow PPOs or MACDs or PMOs or any of these other momentum following indicators, you'll see that once you've had a big move to the upside and you pull back and then you go up again, chances are you're going to pull back temporarily. We don't know how far this next breakout's going to run, and therefore we don't know whether or not the PPO is going to go to a new high again. So if you look back, that negative divergence I just pointed out, even though it was a slight one at the beginning of May, we set new highs on the PPO just a week or two later. And then when we broke out at the end of May, early June, we had the same thing again. And yet we kept going higher, and see how the PPO eventually goes higher. So I would just be real careful about assuming the first time you move higher that there's going to be a negative divergence. It's going to stop a stock from moving higher. Now, I do think DocuSign's probably got the rising 20-day moving average test coming up at some point, whether it's now or whether it's after a big move to the upside and pulls back later. I don't know, but I wouldn't be surprised to see that. But no, for me, and this is just the way I interpret the PPO, I would not be concerned about a negative divergence at this point.
Okay. Tom, I think that wraps it up, my friend. You covered it so well, and I certainly learned a lot.
Good, yeah.
One last question.
Yeah.
Just came in. What's your perspective for world stocks the rest of 2021?
I think we have a global secular bull market. I think world stocks are going higher. I think the U.S. has been leading. I would probably stick with that. Although there was a period of time where U.S. was really seriously outperforming other areas of the world. I don't know that it'll be that profound. So I think you can do pretty well. I think the key, though, is if you're going to trade any of these other markets using ETFs, like, for instance, Germany, the EWG, you've got to pay attention to what's going on in the dollar, because the dollar impacts your return. There's a dollar part of that trade, currency related. So I don't want to get into all of that in this session, but just be aware that if you're getting into something else like the EWG, or if you're going to track, Canada EWC or whatever, you've got to take into account the currency impact in trading those ETFs. So you don't always get the return you think you're going to because of the dollar impact.
Okay, and that note, Tom, I think it's time to wrap it up. I want everybody to know that they're going to get a copy of the recording as soon as practical. And I don't know if you have any last words or if that's about it.
I think that is it for me. I appreciate everybody coming out. And again, we do have a 30-day no-cost trial. So if you haven't tried Earnings Beats, we do a lot of this for our members on a regular basis. I think we put out more information than just about anybody anywhere. And it's not just the same old stuff. I think hopefully from this webinar today, you see that we dig a lot deeper and provide some really useful information in trying to manage portfolios. So anyhow, hope you enjoyed it, and check us out over at Earnings Beats. We do have that special going on till Friday the 9th, so make sure you check that out as well. And that applies not just to new members. That's any of our existing members or trial members. You can use that special to your advantage and extend for a year and get a bonus month as well. So everybody have a great evening. We'll have a lot of events coming up over the next couple of weeks, so check our event calendar out, and sure we'll be talking to you all again soon. Happy trading, everybody.